Welcome to today's deep dive. So today, the Nikkei basically erased trillions of yen in what was its fifth largest drop in history.
Right.
But interestingly, if your portfolio was heavy on domestic staples, like, say, Caesarea or 7 and I, you actually made money today.
Yeah, it's a pretty wild contrast.
Right. So we're going to unpack the sources you sent us and figure out exactly why a massive panic over AI semiconductors suddenly turned, cheap pasta into a hot commodity on the Tokyo Exchange.
Yeah, so what we're looking at here is in a massive capital rotation. The Nikkei plunged, over 4,000 yen intraday before finally settling down around 2,694. And if you look at the heat map, all the bleeding was highly concentrated in one specific area, which is tech.
Specifically AI and semiconductors, right?
Exactly. Just look at the data on Kioxia. It's staggering. Their market cap was effectively slashed in half in under a month.
Half. Wow. So, is this just a case of the valuation rubber band snapping back? Like we stretched it way too far on all this AI hype that it finally just had to snap?
Well, the rubber band analogy definitely works. But the tension there isn't just about hype. It's really about capital expenditure. Think about a massive semiconductor shortage we experienced over the last couple of years.
Oh, right. When everyone was scrambling for chips?
Yeah, so companies spent billions building out new fabs to meet that soaring demand.
But those factories don't just, spring up overnight.
No, not at all. They require a massive lead time. And by the time those new fabs actually come online and start producing, the demand curve has often already shifted. That is the core mechanism behind the silicon cycle.
Got it.
We are aggressively transitioning from a severe shortage into an oversupply phase because all those factories are basically turning on at once.
Okay, I get the cycle, but AI models are, hungrier than ever for memory. If demand for compute is still climbing globally, why would one new supplier entering the market cause an absolute panic?
It's because of the sheer scale of this specific supplier. We're talking about CXMT, the Chinese memory manufacturer. They just secured a 1.6 trillion yen war chest.
1.6 trillion.
Yeah, through a massive IPO on the Shanghai Star Market. So investors aren't just reacting to, normal oversupply. They're pricing in a brutal price war.
So the fear is that CXMT takes that massive influx of capital, heavily subsidizes their production, and just floods the market with cheap DRAM, which would totally wipe out everyone else's profit margins.
Exactly. We've seen this exact economic playbook recently. Look at the solar panel and EV industries.
Right. Subsidized overproduction.
Which led to a total collapse in unit prices. Investors are dumping Japanese and U.S. tech holdings before that impending wave of cheap memory hits the open market.
Which brings us back to the pasta. The capital didn't evaporate today. It fled growth and hid in safety. And it wasn't just domestic staples acting as a life raft.
No, not at all. The financial streams show that U.S. and Japanese banks are thriving right now amid the tech sell-off.
That's fascinating. Why is that?
That's where the broader macro environment comes into play. The same economic forces punishing tech are actively rewarding banks. When interest rates rise, tech valuations get crushed because borrowing costs go up and future earnings look less attractive. But banks, they borrow short and lend long.
So as rates go up, the spread between what banks pay you for your deposits and what they charge for, say, a mortgage, that spread widens.
Precisely. They are essentially printing money on those positive yield margins. And ironically, they are using AI to widen those margins even further.
Really? How so?
Instead of trying to build large language models, banks are deploying AI to automate massive amounts of back-office operations. It slashes human resource costs and drives up efficiency.
So they're using the tech to dig deeper moats for themselves. But looking at the government's response, it seems Japan isn't giving up on the tech sector. They're just shifting focus from digital software to hardware. The press footage today had the Media Minister and NVIDIA CEO announcing a massive new initiative, and they were both wearing matching leather jackets.
Yeah, that was definitely a choice. But it's a 380 billion yen government initiative. They are pivoting hard toward physical AI. The objective is to deploy 10 million AI-driven robots across manufacturing, logistics, and healthcare by 2040.
Wow. It's a huge bet that the real value of AI isn't just a chatbot on your screen, but a machine you can physically interact with in the real economy. So for you, the investor, today's crash is a powerful reminder. When flashy tech cycles inevitably overheat, the boring fundamentals like your local bank or the affordable family restaurant down the street become your ultimate safety nets.
Yeah, the market always seeks equilibrium. When the future feels too volatile, capital runs back to the reliable present.
It leaves you with a lingering thought, though. If Japan hits that goal and integrates 10 million physical AI robots into the workforce by 2040, will the next historic market crash be driven by human panic or by the algorithms running those very robots?